Hello, everyone. Hello, everyone, and welcome to the Bolsa Social Talks, to the third of a series of three webinars. Actually, this one, the whole series called The Power of Participative Finance in Impact Investing, where at the end, this is what we're talking about, right? What is going on nowadays regarding innovation, especially in what we would call fintech, no? To help these kind of companies and other companies also. This webinar in particular is called Innovative Solutions for the Challenge of Liquidity in the Social Finance Market. If I may give a brief summary of what we've been looking at the past week, we had two webinars. The first one talking about crowd equity as just as an innovative solution to the kind of these kind of companies, so that they can get financed and get in touch with the investors community and to start appearing more and more in the business world. We also had crowd lending as another mechanism, which is very useful for this kind of companies and other companies also. And in this third webinar, we will be covering basically one of many problems that these companies can find in the market. There's also external factors which affect businesses, and it is our duty to propose innovative solutions, and in particular liquidity. It's a huge one, a huge problem for these companies, both for the companies and the investors. So basically, that's what that's what we will be talking about here in this webinar. We want to understand what the problems of liquidity really are to these companies, to investors. Also to know what companies are doing to help other companies to overcome these obstacles. Maybe dive into the new European legislation on mechanisms like crowdfunding. The new legislation is also offering some solutions, so we will also be covering those topics, if you will, and that's why we have our guests here from different companies tackling almost like the same problem here. They are all helping to liquidity, but from different perspectives, different products. So without further delay, I'd say I would like to introduce our guests here, starting with Lisa Ashford, who's CEO for Ethics and co-founder and managing director of Energize Africa, which is a platform that has raised, Ethics actually has raised over 100 million Great Britain pounds for social projects. Also, their initiative Energize Africa, which has also targeted an astonishing amount of projects in Africa regarding energy, having raised more than 28 million. We also have Ramon Blanco of Be Water Funds. He is the CEO and co-founder of Be Water Funds, a platform that also tackles quite straightly the problem of liquidity, both from the startup or the company and the investor side. They have in their own platform companies we're maybe very well aware of, like Witaka, We Are Knitters, Think Co-working. And last but not least, Azahara Garcia, who is a former country manager for Crowdcube in Spain, the English crowdfunding platform, who has financed companies like very well-known companies like Revolut or Eura. So that is just a brief introduction. I would like to pass on to maybe Lisa, if you want to start talking a bit more maybe about what ethics is and maybe about Energize Africa, like a brief introduction, so that we get a grasp of how useful your intervention is here.
Yeah, hi everyone. Great to be here and thank you for inviting me. So FX is a positive investment platform in the UK and it has been operating since 2013. It brings money from the crowd through crowd investment into social enterprises, charities and profit for purpose organizations. It doesn't define the type of product that the organization can raise. It very much is led by the organizational needs. And so we have a number of different types of products that we can touch base on. Something which is quite unique to social enterprises called withdrawable shares, which create an interesting liquidity model. We also operate a secondary market for more established organizations, such as a company called Cafe Direct, which you may know, as well as providing some startup funding as well, equity for more sort of early stage companies. And the market in the UK is starting to develop a little bit more as well. So you're starting to see sort of quasi-equity debt products, which again provide a sort of different type of situation when it comes to liquidity. On Energize Africa, we offer working capital debt. So it's relatively short-term, 24 to 36 month products for organizations that are not the smallest, but have probably raised a bit of equity and are now looking for debt funding to scale their businesses. And those organizations struggle to get that type of funding in a flexible and affordable way from banks, for example, and that's where we step in. So that's a bit of an overview of what we do.
Great. Thanks, Lisa. If you will, I'll pass on to Ramon. We'll get in more detail afterwards, probably, and yeah, we'll get the insights of how you work with these companies, how you do it. Ramon, if you want to tell us what Bidwater Funds is, who you are.
Sure. Thank you for inviting me. So basically, at Bidwater, we invest in technology-exposed companies, basically in Spain and Portugal. Every time we invest in a company, we incorporate a fund. Okay, it's a closed-end fund aimed at professional investors. And all the investors, the professional investors, we acquire participations of the fund itself. And later on, we can put the participations in the platform. Okay, up for sale. And of course, there needs to be another professional investor interested on acquiring the fund shares. We do mostly secondaries. So that means that we basically provide liquidity to either investors that finish, that consider that it's time to finish their time in the company and want to basically recover their money, or to entrepreneurs that might choose to diversify their holdings. Okay, because I mean, most of the entrepreneurs, as you know, we all have the majority of our money invested in the company. So we started investing in private companies in 2018. We have invested around 14 million euros in private companies. We already exited one, and yeah, that's about it.
So Ramon, thank you. And Azahara, just in case anyone doesn't know what Crowdcube is, if you want to tell us a bit more about it, and maybe how does it help to tackle very briefly the problem of liquidity, maybe.
Sure. Well, thank you for having me here. Just as a brief introduction, so Crowdcube is an equity crowdfunding platform. Basically, we position ourselves as another channel for companies to raise funds. We work with a lot of different companies in different stages. I think the smallest round that we are doing at the moment, it's around 100K to 100K up to 30 million at the moment with the new EU regulation. And we offer this channel for companies in almost every kind of sector. So we are not specifically working with impact investment at the moment, but we are seeing a raise in this type of companies as well. And we normally work with companies that have a big community of customers, so that we offer them the chance to invite these customers to become investors on their company alongside normally institutional investors as well. So most of the campaigns that you will see in the platform also have the co-investment from either business angel or venture capital as well. And regarding liquidity in particular, I think it was like 2 years ago or something like that, that we actually realized that was a problem in this arena. I think, and it's something that affects almost every company on this startup ecosystem. And we developed a new product that it's actually still on the beta section, which is called Cubex, which basically tries to align the willingness from customers, so people wanting to buy shares into the company, and investors, normally either founders or investors that have been there from the beginning, or even employees that have shares into the company, to sell their shares to these customers that are interested in buying them. So we're doing these two kind of things. One of them, we have been doing it for a very long time. The other one is just beginning now.
Cool. So sounds great, because most of the things that you three have talking about, it almost sounds like, or we would like to have these solutions getting closer and closer to what we understand as the stock market, so that it's very easy to buy and sell participations in these kind of companies. But and just getting into it, if I may jump a step back, and I want to go over what you think what liquidity is like, because there's two sides for liquidity, right? We've got at the investor side and the startup side, like investors trying to get their money back from their investments, but also companies trying to raise them. So we're assuming here that there is a problem, and that's why models like crowdfunding, platforms like Be-Water are surging. So if you want to start, Ramon, telling us, I mean, the very existence of Be-Water funds denotes that there is a problem with liquidity. So maybe you want to tell us about, like, why does Be-Water fund exist? Because there was a problem. What problem is it solving?
Okay, sure. During the last 20 years, basically, my partner, Francois Derbe, who is a well-known technology entrepreneur and investor here in the country, and myself, we both invested in basically several dozens of technology companies, right? Like, for example, in my case, I invested in almost in the founding round of Idealista, which probably everybody knows. Okay, that's back in the year 2000. So basically, to illustrate the problem, I mean, I invested in Idealista in the year 2000, and I basically wasn't able to disinvest, being probably the most successful company in the Spanish market until the year 2012. That's 12 years later. And actually, it's pretty typical. It's a pretty typical time frame to get your money back as a business angel. You're looking basically at receiving back the money at the 10-year time frame, and that's basically why we were interested on looking for something that could basically shorten the time frame, or at least improve the liquidity a little bit, right? That's basically because we saw the pain in ourselves.
This is directed to professional investors, right? Because that's the investor you're targeting in Be-Water. Yes,
actually, regulation is got a lot to do with it. In order to create liquidity, you need to put a vehicle in the middle, right? The vehicle we chose to set up was a closed-end fund. Mm-hmm. Okay, closed-end fund has advantages and disadvantages. Okay, One of the advantages is that it's very easy to set up and is widely recognized by professional investors and institutional investors. So they're comfortable with it. Unfortunately, it's got the disadvantage that retail investors cannot invest in it, right? But that's also coming from the regulator, because the regulator could basically decide that with certain thresholds or with certain minimums, for example, that they could invest up to 10,000 euros or minimum 10% of their portfolio, whatever, right? So I think when talking about liquidity overall in Europe, the first thing you need to look at is the regulation, because many times the regulation is actually the reason why there is no more liquidity on the private equities.
Just catching up with what Ramon just said, is the crowdfunding and all the legislation that surrounds crowdfunding helping to solve the problem of liquidity from the crowdfunding perspective, especially to non-professional investors, retail investors?
Yeah, it depends of the country that you're talking about, because exactly, I mean, we are a UK-based platform, but we have an office here in Barcelona for quite some time. We were operating just in the UK, then we started operating in Spain, and we saw how different it was, what was possible to do in the UK and what was possible to be done here. Until like 3 years ago or something like that, we kind of merged with them, and all the operations that we were doing were done in a European basis, using normally the UK regulation. So this vehicle that was not possible to be established here in Spain for retail investors to invest on them was then a vehicle that was established in the UK, which is good, because for this kind of liquidity events, or for, I mean, the things that we are using, like the secondary marketplace and things like that, it was possible to be used. But for example, we were missing things like the tax incentive and things like that. So that was not, like the ideal option, and there is still not an ideal option. So there is a lot to do regarding legislation, especially in Spain, I believe. But it is true that if things were aligned, equity crowdfunding platforms will be a good way in order for that to happen, as well as it is Be Water Fund, for example. It will be maybe a different way to do it, because one of them will be, I think, a little bit more focused. It will be retail investors, but probably a retail investor a little bit more specialized, more targeting a bit of like / retail investor and business angel. However, if you look into equity crowdfunding platform, you will have this profile and also the super retail investor, like someone that has downloaded Revolut or someone that has gone to buy Eura, and then you offer them the chance to go into the house. I mean, the house will be the company. And if you go into the house and you also have some windows open that let you have the chance to also go outside and let someone else that is interested coming in, they will be a little bit more interesting for that to happen. So I think it would be, the platforms are a good option, but they have to be always aligned with the legislation as well. Otherwise, it cannot happen.
It's very interesting, because you're clearly talking about participative financing models, right? And it sounds like social enterprises, just for their own purpose or their own nature, like social enterprises, like having as much people engaged with their economic activity, it seems like social enterprises could have an extra interest on these kind of mechanisms, right? And I think Lisa here may have something to say, right? Because you only treat with this kind of companies. So would you say there is like an special interest from either the investors or the startup side in this kind of participative finance models? Yeah,
good question. I think it's highly attractive because it forms a democratic way of raising finance. It's allowing individual people and ordinary people to participate in investments, whereas historically finance has been often very opaque and difficult for individuals to get involved. And as long as they obviously understand the risks in that investment, then it can be highly satisfying for individual investors, particularly where they want to see direct impact happening. And I think that's where we come in. we're offering individuals the opportunity to really see what the impact is for each of the organizations that they may invest in. It's highly tangible, it's highly measurable. And these types of organizations, on the flip side, want ethical investors who really are going to join them on that journey to creating long-term sustainable impact. And I think that is a little bit of a difference perhaps with traditional corporates, where, you know, there was a survey done recently in the UK to all of the social enterprises, and one of the things that was, you know, most favorable to them was seeking patient and flexible finance. And the thing is, I think that is the thing which social enterprises need the most, who perhaps are maybe on a slightly more low and slow growth model, that they need long-term finance, and they need it to be flexible depending on the growth of that organization and the trajectory that they're on. So that's not to say that you can't get very successful social enterprises that grow, you know, quite significantly, but a lot of them don't operate, and truly actually would disagree with the principle of 5-year investment and exit. That's not serving their long-term purpose as an organization.
And focusing more on going deeper into what social enterprises or social investors need. Have you seen an increase in non-impact projects trying to access this kind of finance just because of, you know, all the hype about impact investing? How do you think this affects real impact projects?
Well, I think there is a bit of an arbitrage play that some companies might be seeking, that it might look like cheaper funding. And so it's up to organizations like ours to really be quite careful about representing the organizations and making sure that they truly are going to do what they are outlining that they will do, and that the impact is exactly what they are projecting. And I think, you know, there is quite a lot of greenwash in the news at the moment. I think it is problematic for some of the true social enterprises because, you know, theoretically they're trying to compete with organizations that maybe are just being superficially marketed as a sustainable organization. So, you know, it is important to sort out the true pioneers in this market versus those that are just coming in for short-term gains.
Absolutely. Thanks. Now that we have a broader picture of what the problem we are talking about here today is, liquidity, I would like to jump onto the next block of this panel. I think it comes in a really good time, this panel, because you know, the macroeconomic environment is changing. There's lots of buzz about what's going to happen with liquidity. Startups, will they be able to raise funds, investors to get the money back at the returns that they expected to have it back, and so on. You know, inflation going high, expansionary monetary policies ending, with those rates going up. So I just want to throw it here. It's for everyone question. So what's your thoughts on this? How will this affect the stakeholders in your business's activity, whether if it's startups, small caps, medium caps, investors, professional investors, you know, just throw it in.
I mean, from my perspective, negative externalities are not helping a sort of long-term growth model for social enterprises or any company, let's face it. It is a complex time to try and navigate in terms of what are the growth scenarios, and to be able to eloquently communicate that to potential investors in a negative environment can be quite tricky. And I think from my point of view, that's where impact investors hopefully will really play their part, because they're looking at this for the longer term. They are prepared to really look at the true impact of the organization in addition to the financial returns. They're not just looking for the financial return. And markets are cyclical, and we will come out of this. And again, I suppose that reflects back to thinking long term and getting longer term patient investors involved to see through some of the difficult times. But it's not easy.
Yeah. How do you see it, Ramon? How will this affect supply and demand in platforms like yours regarding financing in different companies?
Certainly, investors will be more wary to invest in private companies, especially knowing that they're going to be there for a long time before getting back their liquidity. But two things into consideration. One is that there is already a lot of not only dry powder, but the funds that was raised basically in the last 2 or 3 years. That was abnormally high. And second, is that there will always be good money for good projects, right? So it's about picking the right companies on the one hand, and on the entrepreneur side, as Lisa was mentioning before, is about taking care of cash flow, looking at probably at less growth and more short-term profitability or more short-term sustainability. And the only thing which is sure is that valuations are going to go down, because when you have less funds, less money chasing the same deals, valuations will go down, and that's actually really good for investors long term. Actually, I guess most of the people know it, but there is an inverse relationship between the money raised by VCs in a certain year and the returns of investors 10 years later. Obviously, the less money chasing the deals, the better the profitability for the investors 10 years later.
I was hoping for someone to bring this up, the fact that VC funds or startups, whether they're impact startups or just startups, they want to be more like camels than unicorns, and that this is something that it's coming up quite often lately on what the startup sector is going to look like in the following months, years. I don't know. Athara, crowdfunding players will suffer as much as VC funds regarding this aspect. Is there a silver lining for retail investors here?
It's an interesting time, and actually the last conversations that we are having with the companies, a lot of them that we're thinking about raising money at the end of the year or maybe beginning of next year, they talk to you and they're like, I'm thinking about doing the raise a little bit earlier so that people are not that scared with all this macroeconomic crisis that is coming up. So we are already seeing some changes in the way they talk about it, but then at the same time, I'm not saying all the platforms work this way, but when you talk to platforms which are either doing, for example, impact investment, or the platforms that are doing community-based investment, I think they don't see this affecting them that much, but because the people investing on them are investing on them because of a rational sense, but also an emotional connection. So it's people that really are connected with the company, with their mission, or even if it is just a product or a service, they are also connected to they use it and they know that other people are using it. And they are not investing major amounts of money that could change their lives if the things don't go well. So especially if you come down to impact investment, I completely agree with Lisa. I mean, we are seeing more companies in this regard going into Crowdcube, and you see that the willingness of these investors to invest on them is not just knowing when are they going to get their money back. They just believe in their mission. They believe normally also in the people who are funding the projects and who are leading them, and they are willing to support them no matter the macroeconomic situation. So that's something really good, and I think maybe because of this, they won't be seeing this much of a drama in this situation. But I think at the end of the day, it's a situation that affects everybody, and all the companies are going to see it, and all the companies are going to have to change the way they look into how much money they raise, how they use this money, how they present their business plan. It's kind of funny because when we talk about female investors and male investors, we always see a difference in the way they sell their models. And normally on their pitch, normally men always include, you know, when they are going to do an exit or when they are going to plan to buy back shares from investors and things like that. While women normally try to sell more on their commitment to their project. And I think everything is going to turn around to look a little bit more like that. To offer investors a little bit more of safety on what they are investing and offer a little bit more commitment. I mean, it's a different model. It doesn't mean that one is better than the other. It's just a different way of seeing it. And I'm already seeing some of the difference in the speech coming from entrepreneurs in this sense.
So would we be right to say, if we were saying that there is an increase in impact projects in the pipeline of operations, like platforms like Crowdcube or Be Water, you know, because that is just the investors' interest.
I think there are two things in here. One of them is the fact that I think impact companies are actually increasing, but not because they think that there is more investment from the investor, but because people are actually realizing that there is a need for that. And there is a need for that connected to also a profitability on it, you know, because at the end of the day, entrepreneurs create a solution to a problem. And if you see there is a huge problem that is affecting the whole world or a really big part of the population, and you come up with a solution for it, then profitability comes down to that. And then on the other side, you have the companies who have never thought about impact or anything like that, but then suddenly they realize that if they put impact into it or sustainability into the project, then more people, more customers are going to be willing to buy into them, or they're going to be willing to buy more expensive than if they buy from the competitor. Those are questionable sustainability projects, right? Or impact investment projects, especially if they also think about the fact that if they put sustainability on their pitch, they're going to bring more investors, which happens. So there is when the analysis from companies like Lisa's, for example, or from La Bolsa Social then comes into play, so that investors can have the certainty that they are investing in projects that actually put the impact on the core of the creation of the business. But yeah, I think we are going to be seeing a lot of that in the next months, years to come.
We hope so, right?
It's very interesting because I'm going to have a different view, or I'm going to propose a different view here. We don't have a mandate at the fund, near at the asset manager, to look for impact project or ESG, especially relevant ESG companies. And therefore, we do not look actively for impact projects nor ESG focus companies. We invest in technology-based companies in Spain and Portugal. Okay, and we obviously haven't invested so far on an oil company because we are a tech investor. But theoretically we could, and we would invest in a company that would provide technology to oil refineries. And the reason is that there is no mandate by our investors to do anything else. At the end of the day, our professional investors are professional. First, are professional, and second, they can choose whether to invest with us or not. And second, and third, and even more important, I would say that it is our belief that not all investors need to chase impact projects and ESG companies. You can choose to do so, but certainly there is the state and there is the laws, the legal framework to promote that, and it is not really the ultimate responsibility of the investor to promote it, right? Because the ultimate responsibility of the investors is to look the financial reward itself within the legal framework that hopefully doesn't spoil the climate nor traffic with children or anything like that, right?
Well, I'm guessing, more than guessing, that like other type of financing, other type of projects are still existing. There's still interest. I mean, and there's also probably lots of projects which maybe don't classify or don't market themselves as sustainable, but they still are doing having a positive impact in the environment or not. I mean, it's not a sum zero game, right? So we'll see. We still have like both kind of projects, both kind of investors. You know, why not? And I'm guessing all this. How do we help impact projects or not impact projects to tackle the problem of liquidity? Also goes through the different tools or platforms or mechanisms that we can offer them to do so, right? Startups to raise their money, investors to get it back, well, to get the chance to invest it and maybe to get it back. So we see now, and we have briefly spoke about it, private markets, secondary markets. We're seeing a surge of venture debt, platforms which are focusing on crowd lending, right, Lisa? And you know, using other kind of financial instruments, convertible notes, and so on. So what do you think? Because we've been talking about equity. Lisa, what do you think? Because this is what you do in ethics, right? And Energize Africa. So what role do you think does debt financing play in our challenge of liquidity here?
Well, for us on ethics, debt runs very much alongside equity. So organizations can choose whether they are raising equity or debt, or indeed a combination. We see on our platform on ethics long-term debt, and we also have within the UK something called the Innovative Finance ISA, which allows investors to have interest tax-free. And so it needs to be a transferable product for to be eligible under that wrapper. And so we offer that transferability through a secondary market, which is a bulletin board function. But that long-term debt, you know, acts a little bit like equity actually. And then you're seeing more participation models where it's sort of quasi-equity, so more revenue share models, which allows a bit more sort of risk sharing between the investor and the investee. So that's another option. And then, as you mentioned, Energize Africa is playing a very specific role as well, in that it's companies that have been able to raise a small amount of equity, but in order to sort of scale their operations, they need more working capital. And so we offer a sort of revolving debt facility, basically, where they can draw down that debt as they need it. They're not getting charged any non-utilization fees for it. And the capital is paid back on a 6-monthly basis with interest. So that certainly is helping those organizations, in fact, then once they've proven themselves, to be able to raise more equity. So it's actually a sort of, if you imagine a finance continuum with organizations developing through their life, we're helping to bridge between sort of early equity and next stage equity with that Energize Africa model. So lots of different products dependent on the needs of the company.
Right. So would you say crowd equity, it's complementary to would you say it's complementary or substitute to crowd lending? I'm guessing complementary, right?
Very much so, yeah.
Absolutely. I have to agree with that. And jumping again to Be Water, Ramon, how accessible is this over-the-counter market that you're creating in Be Water for investors? Is there any way to improve it, make it maybe more accessible? Maybe you don't want to make it more accessible. Why? What do you think?
Oh, we would love to make it more accessible, but the regulation doesn't allow it. Closed-end funds in Spain and in most of continental Europe, they can only be invested by professional investors. It's a fact. So we need an EU directive that would change that. There are some steps that might come in this direction of easing the access of non-professional investors to the private equities, but we need to see it, because I mean there's been so many tries before of easing this access, and finally nothing happened. That I'm a little bit skeptical, no. The direction is very clear. The direction is set up in the US and the UK. The ease of access is much simpler for retail investors to private equities. And with regards to a true stock market for private equities, I think we are very, very far away from seeing that. In the UK, you have some good platforms that are trying to solve the topic. One is the Nasdaq private market, okay, which is basically aimed at solving the problem of liquidity with stock options and phantom shares and things like that, and which works well. You also have a project like Capita, which is a true private market in all kind of investors, which is developing as we speak, and it has probably all the good polls to be able to develop it. You have big banks, big investment banks. There are shareholders. You have a lot of information about the startups, which is already there. So they have everything to make something successful, but so far it's not. Okay. So, and if you look at the European markets, not even in the UK, we have a true secondary market for private equities. And if it's not in the UK, it's the situation is even sadder for European continental markets. So we are looking at, I don't know, 5 to 10 years at least to I think, in my opinion, to be able to see something like that.
We could consider Be Water funds in any case at the very present an alternative exit strategy for early stage investors, right? Another way in which these investors can get their money back easily.
Yes, for early stage investors that did invest in a startup and who are looking at disinvesting tickets from, I don't know, 1 to 3 million euros. Be Water funds would be a great place to find liquidity. Okay, but obviously this is a very, very narrow niche of investors, because if you're an investor, you would like to disinvest from 5,000 euros to 50 million euros, no? And that's where you are looking at the true market.
I thought, how good is crowdfunding how good are crowdfunding platforms in providing liquidity to investors? Because you know, you go to these startup events and so on, and we keep on listening that crowdfunding backed companies do not scale as much, and the investors are not able to get their money as easily. Would you agree with this? Is crowdfunding still a good way in which people can invest and get their money back, like institutional investors?
I think if I was an investor investing into an equity crowdfunding platform or a company doing a run through it, the first thing that I will ask about is which is the legal team working in the platform, because I think everything depends on that. It's not just about the regulation in each country, which we have talked about before. You know, it depends in which country you are, things can be done or can't be done. But also, I mean, when we work with a company, normally, I would say it's 80% of the times, the round is co-invested by an institutional investor, normally a VC or two VCs or things like that, or normally the company has some big investors who are also co-investing into the round. The first thing we do is that we ask the company which ones are the conditions that these investors are investing on, so that at the end of the day, the legal team in Crowdcube protects the retail investors. So we make sure that, I mean, obviously we take into consideration that normally these investors have an active participation in the company, which retail investors have not. So obviously there will be some differences considering the rights that each of them have. But at the end of the day, it cannot be that there is a major difference between which rights, economic rights one has and the ones that has not the other. So this is one of the things that we do. That's the first thing. And if you talk about if you as an investor will have a smallest chance of doing an exit, of having liquidity, depending on whether you invest through an equity crowdfunding platform or if you were an institutional investor investing outside, at the end of the day, you have to think about the fact that the round in which you are investing is also co-invested by institutional investors. So if they have the chance to have liquidity out of it, you should also have it. And that comes down to the legal team protecting you as a retail investor. The good thing about platforms like Crowdcube or like Seedrs, for example, also in the UK, it's a fact that because you are investing as a retail investor through a vehicle, then your chance to have a liquidity event through something like QX or through the secondary market that Seedrs have, it's easier because everything is done through the nominee in this case. So you as a retail investor will have the highest chance to do this liquidity event if you do it through an equity crowdfunding platform than if you did it somewhere else outside. So I think obviously there are a lot of variables and things that you will have to look into and a lot of details, but I wouldn't agree with the fact that you as a retail investor will have a smallest chance to an exit, or even I think something that happens a lot is the fact that companies are very interested in having their customers happy. And if they have invited 5,000 customers to become investors in the company, they like to give them the chance to sell their shares. And a lot of the companies into Crowdcube have bought shares back from investors at a very, very good multiple, like Revolut did, for example. And that's something that happens many times. Sometimes we announce it, sometimes we don't, but it happens many times. But that's because it's a huge community, you know. Sometimes maybe companies, they don't think it's that important to have that big investors as happy, you know. It's like, he can wait, you know, we will wait a little bit longer. But if you have 5,000 people who can recommend you, they will probably have a little bit more effort in having them happy. So yeah, you know, it's a lot of variables, but it's fun.
So it mostly depends on the company behind the operation, right? So being a VC fund doesn't prevent you from not caring about the exit of your investors just as much as a crowdfunding platform could be caring, like, right? Okay, absolutely. We're actually on our last 10 minutes, and I wanted to ask you, because we said it at the beginning, right, that we were going to jump a little bit into like, not becoming too technical here, but on the EU new legislation on crowdfunding platforms, and how it is helping investors and startups to raise money or to have the, you know, to give alternatives to investors to either buy or sell their participations. I know FX has its own secondary market, Lisa, so it would be great if you can tell us how it works and how does it help the problem of liquidity a little bit.
So the secondary market, in fact, FX was originally set up to act as a secondary market for ethical companies that had the general public as shareholders, unlisted organizations, and then we added on the primary raising function. So we've sort of approached it from the opposite direction. It's relatively limited activity on our secondary market because people do tend to hold for a long time the investments, and we also have alternative ways of dealing with liquidity on a lot of the community projects where the shares are withdrawable and they do multiple projects and use that as a liquidity pool basically to allow people to exit and new investors to come in. We had to change the way that we operated the secondary market due to regulation, actually. So in order for it not to be treated as a multilateral trading facility, it was changed, and a number of other similar organizations changed the way they operated some years ago to be more of a bulletin board function. So it's a place where buyers and sellers can find each other, but we're not regulated as a trading platform, which is an important distinction. Obviously, due to Brexit, our regulation now is starting to diverge from the European regulation. So we look forward to seeing how that will pan out in future. But we do utilize the secondary market, investors do, and I have no doubt as we have more longer term products and debt-based products, that will grow as well.
Would you expect, like, for a debt market work better, just as the same as an equity market? What's your thought? What are your thoughts about this?
It tends to be a bit more straightforward in terms of the price seeking element, and it depends on the way that you operate the secondary market. So, you know, for one of the companies that's listed on the secondary market, there is always the challenge of the NAV or net asset value of the company versus in reality what people are prepared to pay for the shares. And so in that sense, it can be a bit more tricky for equity secondary markets. Whereas for debt, it's a bit more straightforward in terms of the actual transfer price of the investment. Mm-hmm. So you do see a slight difference there.
And Raman, I wanted to finish with this question because you talked briefly before about this, but and I also said this is starting to sound like the stock market. So I'm guessing this is where we're trying to get, right? So from your perspective and your expertise, how far are we from that secondary market that looks like the stock exchange regarding earlier stage companies, whether if it's with debt or equity? What do we need to get there?
I think we are very, very far away, as I mentioned before. In order to get there, we need the legislation to be to allow it to start with, because right now in Spain and I guess in most of continental Europe, if to be a multilateral trading facility, okay, either you are coming from a group like the traditional stock market groups, okay? Or you need to fill out, so many conditions that it's practically impossible to build competition into it. And competition is what drives innovation and what decreases costs. So we need to see a real push into bringing competition into the market, which is not the case right now. There are some nice projects around the world of blockchain and tokenization in order to bring in liquidity, but in my opinion, this is basically just nice to have. But the big money is with the institutional investors, and I don't see the institutional investors investing in tokens of any kind, in a big way in the next 5-10 years, right? So in order to have a real secondary market for private investments in Europe, we will need to have the regulation on our side, and second, we will need to have some big promoters, some big investment banks like JP Morgan, Goldman Sachs, the ones who are promoting capital, for example, in the US, bringing actually liquidity and deals into the market. So very far away.
Very far away. Okay. Well, let's hope it is shorter than that, right? Because it definitely we would expect it to be helping a lot in terms of liquidity, of course. So yeah, a very, very, very interesting conversation here. I want to thank all of you for participating. We've gone through the different solutions for retail investors, professional investors, and the different ways in which they can tackle or try to mitigate the problems with deriving from liquidity, right? We have also spoken about social enterprises and how maybe they could be better off with this macroeconomic environment, right? These investors not only looking for economic benefit, but also to create impact through their own investment. So let's hope that works just as Lisa said. We've also gone through the different variety of products, debt, equity instruments like secondary market, equity crowdfunding platforms, crowd lending, and so on, and how they help us to again mitigate the risks of liquidity regarding this kind of investments in early stage companies or projects. We've also talking about the perks of the regulation, but I would say, to sum it all up, it seems like we are on the right direction and things are coming up to solve all the liquidity problems regarding early stage companies funding. So I don't know if any of you want to add anything else to the conversation. If not, I just wanted to thank you, Lisa, Azahara, Ramon, for having us, for sharing your expertise with us. Hope to see you again soon.
Thank you very much.
Bye-bye.
Bye-bye.